Let's zero in on the markets. Our guest says Nvidia's latest results have validated the thesis that the AI boom is sustainable. We're joined by Jay Hatfield, founder and CEO of Infrastructure Capital Advisors. Great to see you. We know that Nvidia posted a blowout, and so you say that's evidence that this AI spectacular, this boom, has legs.
Yes, thank you for having me on, Andrew. So if you listen to the call or look at the transcript of the call, they're talking about there was a bare thesis that this was just R&D being really carried out by the major cloud service providers. But the call validates this is a very broad implementation in the enterprise and even in sovereigns in multiple languages. So this is a global trend. And we also think that a validation of the implementation came from Jamie Dimon, who indicated that really every department is implementing AI. So the bears, I think, were wrong about this. We've been bullish about Nvidia. We have a $1,000 target. And the reason that's important is not that we're recommending Nvidia necessarily, but it is absolutely supporting the market. Sort of no matter what happens, it goes up. It's an important part of the S&P. It builds momentum. So it's one reason we raised our target to 5750 on the S&P for the end of this year.
And Nvidia itself hitting record highs north of $921 today. You say Nvidia is headed for $1,000?
We think so, but we'd also indicate or warn even that normally in technology booms, you have overvaluation. And that's the reason that North American companies tend to always be first to market in technology, is that overvaluation then drives private capital into startup new companies, and they go public to try to take advantage of that overvaluation. But in the initial phases, which is what we believe we're in, you just have the existing companies and they can go to higher and higher levels until those IPOs start. So that's our fair value, but we wouldn't, it's not like we would short it at 1,000, like it can go to 1,500 or any number really, because once these booms start, they're hard to stop.
You have some stock ideas for us. This category, not tech. You like the look of some of the big investment banks, Morgan Stanley, Goldman, and you note that Morgan Stanley has a yield of about 4%. So you see promise there for those bankers?
We do. We're carrying higher earnings estimates in the street by almost 20%. And the reason for that is really the investment banking boom's already started. It's focused on fixed income, which a lot of people don't care about or look at, but we're record volumes in fixed income. M&A is picking up. Equities have lagged, but they typically heat up during the summer. And we do think this morning's ECB meeting was highly bullish, very bullish, in that President Lagarde really validated a June, or implied at least a June rate cut. So we think once a broader rally develops, we'll get IPOs, and that feeds all of their businesses, not just investment banking, but sales and trading, wealth management. If equity prices continue to rise, that helps asset management. So those are the companies most levered to this very strong stock market. And we are cautious about regional banks because of obvious issues with net interest margin and commercial real estate.
You have some small cap dividend ideas for us, starting off with Bloomin' Brands, which owns Outback Steakhouses. The yield about 3.7%.
Yeah, so that's a stock held by SCAP, our small cap dividend fund. We do think that company, because it's a small cap, has been unfairly penalized, trades that are reasonable, about 9 times earnings. And there is an activist involved. So they may try to put it up for sale, or they may at least try to improve operations, improve margins. But even if they don't, it's just a flat out, very cheap stock and a proven concept, Outback Steakhouse.
Well, you've got a real estate idea for us, Kilroy, the yield of about 6%. Now, it's real estate in tech-focused markets?
Yeah, so everybody is kind of obsessed with this notion that we're always going to work from home. and there's never going to be in demand for office space. And that might be true for B and C offices, but they own A offices in tech centers like the San Francisco Bay Area. And we know from talking to brokers in that area, the AI startups are definitely taking up some of the space already, and they are work from office. They need to be first to market, as I already mentioned, and you can't do that phoning it in from the south of France. So you have to get in the office. It's more like what we used to do in investment banking, which is LFO, live from office, which has its advantages because you save on rent. But this whole idea of working from home doesn't cut it in these, fast-moving startups. It can work in Google and some of these large companies, but it does not work for these fast-moving startups.